Hey guys, so in this video, I want to share with you a trade that I did where I sold an in-the-money put option and made 155.73% in 9 days. So I want to very quickly just go through this trade with you and share with you the reason why I decided to sell an in-the-money put option as opposed to selling an out-of-the-money put option, which is that's what most people do, or even sell an at-the-money put option. Okay, so this trade was done on the QQQs. And on the 23rd of May, this was what I saw. You can see that the market has been selling off pretty hard as there's been a slew of bad news coming out. And you can see the stochastic oscillator has been showing that it's been oversold for quite some time now, right? So on the 23rd of May, at the price of 290, I went to sell a cash secured put with the strike of $300, right, with a 65 delta, and there's days to expiration left is 53. I sold it for $20.01, so that is $2,000 and $2,001 in a premium. So you might be wondering, why did I sell an in the money put option as opposed to selling maybe an out of the money, where I could have sold maybe the 260 strike or maybe even the 270 strike? Or why didn't I at least try to sell and at the money at around 290, right? So why did you want to sell and in the money? It just doesn't make sense, right? Am I crazy? Am I out of my mind? Right? So hear me out. Let me explain. You see, the reason I decided to sell this in the money put option was because this was what I saw. Right, the market has been making new lows, and then as you can see, it's making a lower low, lower high, lower low, and then there's a resistance at this point down here. You can see this was the previous low, so price tried to break below this low, but it couldn't go below this, and it closed above this previous low, and then it formed this nice candlestick down here. This is what we call a pin bar, right? Let me just remove this drawing so you can see this clearer. So this is what you call a pin bar, a bullish pin bar, and basically what it indicates is that there's a good chance the market, right, the bulls are winning. That the market has a higher probability that it will go up than it will go down. Now, of course, this is not guaranteed, but there is a higher probability with this candlestick pattern because it was paired off with a break of a previous low where it couldn't close below it and it ended up closing above. On top of that, there is a divergence. So you can see the market is making lower lows, right? So let me just use another color here. So it's making a lower low down here. But if you were to take a look at the stochastics, this is the stochastics, it's showing that it's making a higher low, right? You can see it's making a higher low, but this is making a low low. So this is what we call a divergence. Now, a divergence is a bullish indication that again that the market has a higher chance of it going up than it going down. So there is a confluence of indications that it is going to go up. So that is why I decided to sell an in the money put, because I think that the market has a good chance of it rebounding very quickly in the next few days above, right? So what exactly is the in the money put? So let me just explain to you what the in the money put consists of. So most of the time when we sell a put option, most of the time, especially when you sell an out of the money put option, let's say 280 or even 270, in fact all of the value is actually extrinsic value. Extrinsic value basically is just time value, and that means that it will decay all the way to zero on expiration date. But with a 65 delta put option, you notice there is a mix of extrinsic value as well as intrinsic value. So extrinsic value we already know is time value, and it goes to zero the moment the option expires. Intrinsic value, on the other hand, does not expire. It does not go to zero because of time. Intrinsic value is basically just the difference between the current stock price and the strike price. All right. So at the point of when I was selling this in the money put option, it was $290. All right. Let me just go ahead and remove these drawings. Okay. So at the point of time when I was selling this in the money put option, the price was at $290. Okay, so when I sold the 300 strike price, it means there is a $10 difference between the price that I sold when the market price when I sold the put option and the strike price. So this $10 in intrinsic value is basically the difference between this, which means to say, even if the market right now, let's say on the day itself I sold it, it was to rally up 10 points just on the day itself that I bought it, I would have pocketed this full $10. This $10 in intrinsic value would become $0. That is because intrinsic value is pretty much just like buying shares, right? It's the capital gains in terms of the movement. Now, of course, on the other hand, if the market was to go down $10, right? If the market was to go down $10, what do you think would happen to this intrinsic value? Right? This intrinsic value would now become $20. That means I have a loss of $10 because I sold it at $10, and when it became $20, if I buy back at $20, my loss is $10, which is $1,000 per contract. So this is what intrinsic value is. Intrinsic value is when I expect that the move of the stock is going to be pretty quick. That is why I decided to sell the in the money put as opposed to selling the out of the money put option. Okay, so if we compare an out the money put option or even an at the money put option, okay, so let's just compare. Let's say if I were to sell the 290 put option during that time, that is at the money. At the point of time when I saw the 290 strike price, the premium which they were selling at is roughly $15. Okay, so $15 for an at the money put option, which I received the premium if I were to sell it that, compared to a $20 premium. Now, the thing with extrinsic premium or extrinsic value is that if even though on the day itself, if it was to go up $10, chances are this $15 would only drop down to roughly maybe $12, right? So if it became $12, my profit would only be $3. So that's roughly $300. So I made $300 when the market has gone up $10. That is the thing with extrinsic value. Extrinsic value is only profitable over time. But if there's a big move in the direction that you want it to go, the profit is not going to be that big compared to intrinsic value. So that is why I decided to sell this with a good mix of 50%, which is extrinsic value, and 50% in intrinsic value. This way, once the market goes up here, I would immediately make the money on the intrinsic value, which means I already have gotten 50% of the premium. And then I would pocket a small portion of this extrinsic value depending on how long it took to get to this point, right? So let's take a look at what happened in the next few days. So on the 1st of June, which is roughly 9 days later, right, this is what I saw. The market became overbought, which is pretty quick. As you can see, the moment I placed an order at this point, the market dipped down a little bit, after which it went up. So it rallied even past my 300 strike price. So at this point, because I saw that the market was already overbought, and we are after all in a bear market, the market wants to come down, and as you can see, there's a moving average here which serves as a dynamic resistance. I wanted to get out of this trade. Okay, so that's what I did. On the 1st of June, I decided to buy it back for $8.49. So this was above the strike price of $300. Above $300, which means I actually gotten the full value of the intrinsic value. This $10, I pocketed it because it went past this 300 strike price, which is more than $10 in intrinsic value. So this $10 became $0, and then this $10 portion became the $8.49, which we see, which is the value which I bought it for. So what does this mean? It means that the extrinsic value only decayed roughly how much? $1.51. I only made $1.51 out of the $10 in just 9 days, right? Why is it so little? And the reason is because you can see I sold the option with 53 days to go, and this whole trade only took 9 days. So that is why there isn't that much extrinsic value that got decayed, because extrinsic value again mostly decays over time. All right, even though if there's a big move, all right, there will be slightly more decay, but not as much as compared to an intrinsic value move. So that is why I decided that on this day it's time for me to close it out and then take my profits, as I saw it is overbought. Okay, so what is the total profit? So the total profit is $20.01 minus off $8.49 times 100 shares, that is $1,152. Now I want you to ignore this 1 cent, because this 1 cent is basically given to the broker, right? The broker charges about 70 cents per option. So when I wrote it for $20.01, this gives me $2,001. So the $1 is given to the broker. Okay, so this total profit of $1,152, the duration is 9 days, and the annualized ROI is where I take the $1,152 divided by the cost of the option if I were to get filled, and then I divide it by 9 days times 365 days, total of 155.73%. Now, the important thing when I entered this in the money put is that I had the cash to fulfill this $300 in case, right, the market went down. So I was already prepared to get long if for some reason this trade didn't work out. So here's the thing. After that, the market did go sideways and go below where I entered. So as you can see, my exit here was a pretty good exit. It's pretty much at a high, because I took a look at the indicator and it says overbought. I decided to just get out. So you can see the market just started to dwindle sideways after that. Now, what happens if the market didn't go up, but instead it went down where you sold in the money put? So you might be wondering, maybe this is just a lucky trade and that it just happened to go up, right? So this is the thing. Before I enter any trade, and before you enter any trade or any investment, you need to ask yourself a few questions. The most important thing is you want to ask yourself, what is the worst case scenario? Okay, you want to be okay with the worst case scenario before you go ahead with the trade. So for me, when I enter this trade, I ask myself this: the worst case scenario, what would it be? So the worst case scenario would be I will get assigned at the $300 level, and then I will get to keep the $20 in premium, which is total of $2,001. So would I be okay with that? And the answer is, of course I would be okay with that. And the reason is because, you see, if I were to get filled at this price at $300, to me it is actually a pretty good price for me to enter as an investment as well, because QQQs has already dropped considerably from the highs of roughly $408.71. Right, from $408.71 it dropped down to $300. That is roughly a drop of 27%. Right, the market has dropped 27%, and even though if the market, let's say for example, the moment I sold it at this point, the market decides to go down, I'm perfectly fine with holding the price at $300, because it is a pretty decent price for me to enter, and at the same time QQQs in the long term would go up. So I don't mind holding this even as a long-term investment. So the same thing for you as well. When you enter a trade, you want to ask yourself whether this is something that you can go through in the case of a worst case scenario. Okay, so let's have some takeaways after we've seen that, right? So the first takeaway is that extrinsic value is essentially time value, and time value will decay over time. At the end of the expiration date, it will always become zero. Next, there's intrinsic value, and the intrinsic value is just basically the price difference between the stock price and the strike price, and intrinsic value doesn't decay. So when you're selling an in the money put option, it does have these two value, the intrinsic value as well the extrinsic value. Now you might be wondering, if I wanted the intrinsic value for my trade, why didn't I just outright just bought 100 shares at a price of 190, right? And that is a fair question, but the problem with that is that if you were to see the market, let me just go back very quickly to the market. If you were to just see the market down here, the market in the end ended up back at $290. So if I were to just buy down here 100 shares, all right, then what happens is that at this point of time, I would still not exactly make any money, right? And if it gone up, if I were to take profit down here, I would only make about $100, sorry, a $10 move for 100 shares, so that'll be $1,000, but I wouldn't be able to profit in terms of the extrinsic value. Now the thing is that, what if the market actually went up and down below the strike price and it took a long time before going back up here again? So in this case, not only do I make money on the intrinsic value portion, I also make money on the extrinsic value portion, because some time have already passed. If you were to just hold on to the shares and you waited all the way until it became 310 to sell away your shares, you would only make the full intrinsic value of $10. But with the in the money put, with the extrinsic value, you make both ways. So that is the reason why I decided to sell that in the money put. Alright, so the next takeaway is that if you expect a movement to the upside pretty quickly, pretty soon, you can sell an in the money put option, and normally it's around 65 deltas, where you have 50% in extrinsic value and 50% in intrinsic value. And finally, you want to ask yourself this question before entering into any trade or any investment. You have to ask yourself, what is the worst scenario that can happen? And if that happens, are you okay with it? And if the answer is yes, you have the money to fulfill the obligations in case you get exercise on your put option, then there's absolutely no reason why you shouldn't take the trade. Alright guys, I hope this video has been helpful for you. If you like this video, please give me a thumbs up, and also please subscribe so I can create more videos like this for you. Alright guys, thank you for your time, and I'll see you in the next video.